Hi there all, and welcome to another quarterly CBAM update. As ever, myself, Mark Inslee, and Samuel Hallett, co-portfolio manager, on the webinar with us. I think last month we had some great questions. So as ever, we'll sort of work our way through the slides, given both the performance and outlook views to you guys, and then try and end the presentation as ever with an opportunity for any questions and things. As ever in these presentations, apologies for the repetition of these, but the presentations are non-advice presentations. We sort of have a collection of clients and non-clients joining these sessions. So just a reminder, nothing's constituted advice in these. That sort of comes through the direct relationship with advisors and Cape Berkshire. As ever, we will sort of go through the performance and activity and what were the factors in there. Sam will give a much deeper dive into under the hood, as he terms it. And again, we are now in quarter four, Christmas approaching and stuff. So we'll sort of round off with where we think the rest of the year is progressing. I think this week there always seems to be a busy week before these webinars, which is good. It sort of gives us sort of a bit more meat on that sort of like forward-looking view, whilst allowing us to recap. But again, inflation number in the UK this week came in low, which Sam was sort of straight on the WhatsApps as US bonds were doing different things and stuff. So again, he'll talk more on that, but just reinforcing the sort of active nature and constant monitoring of your portfolios with Cape Berkshire. But I will hand over to Sam, who will take you through some of the details in more detail.
Good morning, all. It's good to see good list of attendees today. Sorry, Mark, let me just mute you a second. There we go. It's good to see some regulars and some new faces on here. Let's kick off straight away looking at how we performed last quarter. So what we see here is that unlike what has been the norm for seems several years now, we saw a quarter where we had positive growth on all portfolios, but the more fixed income heavy portfolios, that being the ones, twos, etc., outperformed the heavier equity led portfolios. There's reasons for this, one of which being that we came into an environment where through the cycle that government bond yields were quite high. And as we went through the quarter, we had a series of macroeconomic numbers coming out of the States that didn't look too healthy. Some people interpreted it as, and that resulted in a sell-off in early September. You'll see that, but also that right at the beginning of August was caused by the Bank of Japan coming out very unexpectedly with a more aggressive monetary policy than what was expected and was communicated. And one thing markets hate beyond anything else is uncertainty and not knowing what's coming up. So that's why we had those real hard pullbacks there in those two beginnings of the months. What's important to note, though, was the recovery that followed. We saw, in both cases, we saw a full recovery of the portfolios. And in the lower down risk portfolios, we actually saw an increase in the growth. And that's because government yields came down, which impacts more the lower down portfolios. As yields go down, capital values on bonds increase. So that helped those lower down portfolios with their performance. So we see that on P. Obviously, it's the same on R. Slightly different with R. One thing that P benefited from was the pound dollar interest rate, sorry, not interest rate, the currency exchange rate increased at one point up to $1.34 to the pound, and that we do have a degree of hedging on the P equity portfolios that helped us, elevate those returns, which doesn't exist within the R portfolios. So it didn't benefit quite so much from that. One thing that is still the same though, we still have positive growth across the quarter, and that very much continues the theme that's been going on all year long. Throughout all portfolios, 10 out of 10, outperforming their benchmarks year to date, which is of course what we like to see. In case of P, we see that actually not only are they outperforming their benchmarks, but they tend to be outperforming the benchmark above, so to speak. So the P portfolios have been performing really well this year, so we're really quite happy with that. I see there, beginning of August, just how much of a dip that did cause for a couple of days, but we saw very much that in both instances, market reactions, news is very much often overtraded on the day. We saw that people were being irrational with what things were being priced at. It made Japanese equities very attractive. Unfortunately, due to the time horizon, we weren't able to buy more, but we were able to hold our position and not get panicked and sell out from these situations. So we saw that recovery through, and it's resulted in a continuation of performance. Same again there with our 10 out of 10 outperform, sorry, 5 out of 5, our portfolio is outperforming their benchmark across the year. And considering we're at a point where money market returns, so obviously cash is returns from here on out will be decreasing. So we've just come from an environment where the highest that cash returns are going to be for this monetary cycle. We've outperformed cash in all portfolios, so we're really quite happy with how that has happened this year. Looking at the top and bottom performers of the quarter, so unusually, normally we're talking about at the top of the best performing is equities. We see this quarter on the P, we see largely fixed income, so bonds outperforming there. So see the Man GLG funds in first and third. They've been really good funds for us for quite a long time now. We have really good faith in the fund managers. Not only is the sector performing well, but they are outperforming their sectors. And that to us is really, really important, that we make sure that we are only utilizing active funds where they are adding value. We see there that whilst the fifth worst performing fund is the Fidelity Index US, so that's the unhedged version of US equity, where we have in the P portfolios a degree of currency hedging. We actually see that the hedged version was actually the second best performing fund on the quarter there, with some nearly 7% difference in the performance there. So that's something that P can add in the right times. We can be dynamic with that and add when need be, whereas ours meant to be a more simplified investment process and doesn't use within equities where possible hedging. On our web, we see that the China index fund outperformed by quite some margin, which I'll talk about further in a moment. But we also see there second that the Global Real Estate Dividend Index Fund performed well. This is a fund that performs largely similarly to how corporate interest rates work. So what we see there is, as expected, as corporate interest rates have fallen down a little bit, we see that that fund has performed quite well on the quarter there within our. Just looking at the trades on the quarter. A little bit of a light quarter compared to the last quarter. Last quarter we had 31 trades, which was by far our most active quarter ever. This quarter is 17. We see here quite a bit of rotational things occurring and some removal of some active funds, which we weren't finding were delivering value for portfolio holders. So we see at the on the 5th of, sorry, I'm just trying to add my little created line Okay, I might just have to do this instead. So on the 5th of September there, noticing that Fidelity Japan isn't really delivering. It isn't just a case of us picking necessarily the wrong mandate of what we're trying to achieve. It was also the fact of they weren't delivering very well upon their mandate. So it's that key factor there that made us look around for replacements. And Nomura Japan strategic value there is actually performed really well over a continuous basis, whilst not deviating too far away from the underlying benchmark. So they're adding value, but not necessarily at a huge amount of, or indeed not a measure of risk over and above their underlying benchmark, which for us is really, really important. Above that, there we see the LNG Global Thematic was sold down. This was on the size of a fund, had become just over £10 million, of which we made up around about a third of that. So for us, that's became a big concern. But with that size of a fund, is it, from a business proposition for them worthwhile continuing it? And what we didn't want to have a situation was that the fund was going to end up closing, and then we'd be stuck in a situation where portfolio holders couldn't withdraw from their investments because of there's a suspension on the fund, etc. So we took the opportunity to rotate that out and move it into the ATM Global Focus Fund, who we have a great relationship with. Seeing their MSCI China sell down and move across to the Artemis Smart Card, which I will talk about in a future webinar. That fund is a fabulous fund, and look forward to talking about that further in due course. Similar to Fidelity Japan, reasoning for exiting there is the Alliance Continental European move out and moved that into the passive holding that we also hold a HSBC European index. So that would have also resulted in a bit of a decrease of cost on the fund there. And then we see on the 17th, when we were kind of at the peak of some traders believe that America was about to go into a massive recession and completely overblown. We utilized that opportunity there to sell some of our treasury position there, and take some of the gains that had benefited us. Obviously, when a risk environment tends to occur, people tend to buy the risk-free sovereign bonds. So we did that there. What we've seen though since is that we've got good consumer spending, we've got good GDP figures, and there's further reasoning that although there is a softening in US macro data, it certainly isn't the recession that some people were making it out to be this time last month. Similarly, as treasuries moved down, so did gilt yields, so we did the same there. We have reversed that though as of beginning of this week, and entered back in around about 0.5% of yield above where we sold. So that's worked out quite well for our portfolio holders. Just highlighting what I spoke about there. Furthermore. Okay, so looking at quarter 3, what happened? So quarter 3 earnings season was a bit of a mixed bag. There was a couple of misses, although they came in around the area that analysts were on a mean basis predicting. We had a few people being a little bit overly optimistic, particularly on things like Nvidia, etc. And this resulted in a bit of a pullback there on those those equities. We've seen a little bit of the end of the AI equity euphoria, and those just going off into the stratosphere. We've seen a little bit more reasonable kind of valuations starting to creep back into those, which I think for long-term sustainability of the market is a far better thing. Touchdown government debt yields, they moved around quite a lot on the quarter. We were very active when we were moving in and out, and we certainly added extra performance into the portfolios over the quarter with those trades. 3 leads into 2. Japan, just spoke on. US macroeconomic data. What we're seeing there, as I just touched on, was some softening. US manufacturing managers information does point to a bit of a contraction. However, the services data, service industry data for the US is still looking very strong, very much into positive territory. So on the US as a whole basis, it's still going, but a little bit softer than before. And then we move into China. So China has been struggling for some time, as long-term portfolio holders will know, with reduced consumer confidence, chronic issues in their property sector, massive oversupply, kind of the opposite of what's happening in the UK, of property, and also a lack of willingness by borrowers to take on borrowing. There's been a bit of, some people's fingers have been burnt and they're not really wanting to go further with that. What we saw towards the end of last month was both the central party as well as the central bank release a raft of new policy measures to help promote both lending, help to shore up the property sector, and to try stimulate some consumer spending there. So they reduce how much capital that banks have to hold by about 0.5%, which released about $141 billion into the financial system. So this was not a small amount. They further reduced the 7-day repurchase rate, which is kind of similar to our base rate, by 0.2% to try stimulate further lending, and also stated that they were open to further cuts this year. That depends on how much money was moving around in the system. And also their change of policy. So in China, they have a different rate for new mortgages versus existing home mortgages. So previously, it was cheaper to go out and buy a mortgage, for a new property than it was an existing property. They brought that now in line, so you can get a mortgage for an existing property at exactly the same rate as a new property. And the average reduction there works out around about 0.5%. The down payment required to purchase an investment property was reduced from 25% down to 15%, again increasing the liquidity within the market. And a really big facility increase has been that basically the central bank is now going to be purchasing vacant properties in China to reduce the oversupply issue, to shore up the capital values of the market. So I think that is a really important point, that they are reducing the oversupply. And then a couple of elements there with regards to an asset-backed swap program, which just helps the financial stability of 6 regional banks in China, as well as an intervention into the equity market itself, and a further tier 1 capital boost. So they're purchasing stock in several banks to stabilize their stability if there is a downturn. I'm not saying there is a downturn, but if there is a downturn, much in the same way in Europe we have very high tier 1 capital ratios, so that we have very stable banking system post 2008. So all of these measures this is a really big set of measures. But the problem is, though, as I said, a lot of consumers within China's hands have been burnt by lending over the last few years. It's about whether or not the consumer then feels confident to then go out and start spending money again. Retail sales in China have not been positive of late. And in fact, inflation has basically been flat now for close to 2 years. So this is very much about trying to get the consumer out there, but it's not necessarily always going to work. So what effect does this have on markets? Well, initially we saw a massive rally here. So from the beginning of the quarter, close to 15%, but from the base there, it was around about 35%. As you know, market euphoria was going, but then we started to see a couple of data indicators come out after their public holiday, and since then we've had quite a come down from those highs. And looking at over the quarter, we're up about 10ish, somewhere between 7 and 10% really. But saying that, I have a personal belief that will probably come down a little bit further, and that there's other macroeconomic factors at play rather than just a sheer let's put money out into the system that need to happen within China before things improve. And that's why we rotated out from China into a wider emerging markets fund within the quarter, just because of it's more about what's actually going on rather than some stimulus euphoria. It's about being sustainable with the portfolio. And then looking at the funds in focus for the quarter, or under the hood, as Mark says, I like to call it. This month, looking at the Atlantic House Defined Returns Fund. So this is a fund that we started using close to 12 months ago, and we increased the allocation a little bit lately. For those people who are familiar with structured products, it is in essence a structured product fund. For those people who are not familiar with structured products, a structured product is a contract which states at a very simple level, if the underlying market were to do this action, you will receive this performance within this contract. So it's what's called performance by contract by some people. It removes a little bit of the estimation work that goes into obviously equity valuation, and it can be very useful when it comes to sideways markets or markets with a little bit of a downturn. So what we see here is a collection of large cap indices. So you've got the US there in green, which isn't surprising, has done amazing over the last 10 years. And then we have in blue, UK large cap, followed by in grey, a European large cap, and red is the fund. And what we see there is that over the large periods, bearing in mind that this fund is largely UK European based, is that we see that the fund has outperformed over the longer term, whilst at the same time has incurred less loss in volatile periods and has been more stable with its returns. So it increases a degree of stability with performance return within a portfolio, perhaps, which is something that I think is quite attractive at the moment, particularly in we're introducing a global version of this, which has an increased North America holding, and North American valuations at the moment. Some of the factors are starting to look a little bit expensive again. So this is in there to help protect. For those people who, so as they are contract based, obviously you have a counterparty. In this case, you'd be like taking a counterparty up with an investment bank, etc. What's important with this is that 92% of these are backed by gilts. So basically, your credit risk ends up being ultimately on the UK government. So we would certainly like to think that the UK government isn't going to go bust, which certainly makes these contracts very stable indeed over the longer term. So what does this look like? So as you can see there, we've got a calendar performance over different years. Just want to point out a couple of periods. So on the right-hand side here, we've got, for example, 2015, which is a perfect example of what I was just talking about. Markets largely sideways. In fact, UK large cap was slightly negative on the year, and yet the fund still returns 4.25%, just adding that stability as I was mentioning. And you still have very good years as well. You see here in 2016, for example, next door to it, markets did have a good year, but again, so did this fund. So it can, although in very, very well performing markets, the underlying will outperform, but up to say around 10% per annum, this will keep up, but also give you a little bit more protection on the downside. There you go, that's exactly what I wanted to lead to. So this is a 12-month, this is a view as of the end of last month. So if we were to say look at for 1 year, which is the second line here, oops, my line tool has disappeared. See in the flat market, which is in the middle, if the markets move completely sideways, this fund still returns a 7% return. It does keep up with the market. If the market goes up 10%, the funds will return 9.5%. If the market goes down 10%, though, this still returns a positive growth of 2.53% is what's forecast over the next 12 months. So it helps adding that stability that I was talking about to help really stabilize returns and help keep things positive, which is certainly one factor that we like to do. And I think no, okay. So, and then the average cover within the fund for the fund to return a positive return. So markets on average could decline by 33%, and this fund over the lifespan of the contracts will still return a positive return. Markets could go down by as much as 38% before this fund would start to see a capital loss. So there is that degree of resilience over the lifespan of the contracts that are within the fund that can, help add in the downturn real positivity, but we can still generate some upside there, even in a positive market. So that's something there that I think is quite useful. Mark, did you want to talk a little bit more about SPs, just very quickly?
Sorry, I was just no real major further comments. I was just getting close to jumping off on the advising of them. I know there's something we're sort of very passionate about as a business, and yeah, to see them in CBAM and increasing in CBAM, does make sense. We've used them as AWM for 11, 12 years now, and there was a hell of a lot of scare post Lehman's in their use, but there's barely, I'll be corrected, but I think there's barely been a credit event in the retail structured product market that's sort of had capital losses in the last sort of 5 to 10 years. So there's been a lot of good years of in SIPs and things like that, us banking 8, 10, 13 percent rolling returns. They're a useful product. As ever, slightly drifting to advisory there, but they now do have a home in the CBAM portfolio. Me and Sam speak about them fairly often. I think they are a great risk off if we're starting to think equity markets are feeling expensive. Definitely gives us an alternative to going to a quirky alternative, or to going too heavily into bond markets and stuff in higher risk portfolios, because ultimately they sort of do sort of still sit there and be graded as an equity driven product, because their underlying is normally 90% of the time tied to the equity market. So yeah, it was a good one, I think, to bring in as the fund in focus, because will continue to be a good tool. And I think I don't know if you mentioned there the size of the fund, Sam, but I think it's one you've been keeping an eye on and getting more comfort as the actual size has grown as well, which only adds to the diversification of the range of products there as well.
Yeah, that's really important. With all of the funds, as I mentioned earlier, with the LNG Global Thematic, we are very wary of the minimum size of funds. The last thing we want is suspension events caused by liquidity issues, and that's really important when we're making our portfolio makeup, is to make sure that it doesn't impact clients when it comes to, say, pension withdrawals, etc. So the diversification within this fund is also paramount as well. So yeah, just user structured products. The gilt backing reduces the counterparty risk associated with SPs. The fund's been particular fund has been running, I think, for 13 years now, at which point, it can demonstrate all the factors I was just talking about. For forward-looking analysis, suggests, there's going to be positive returns which outperform the underlying index over the next 12 months, where the underlying returns between -10% and +10%. So, there's a 20% window there that we both return a positive return and outperform the underlying indices. So that could be very positive there. Just looking at this quarter, so as you can imagine, I'm attending a lot of seminars, and an awful lot of them, you spend at least a third of the time at the moment talking about the US election. So looking forward to this time next month when we're not talking about it quite so much. At the moment, it's a little bit of a coin toss, who it's going to be, whether it's going to be Harris or Trump. There's different areas of the market which will benefit from either candidate. So a Trump win won't be as good for US Treasuries. So that's their sovereign bonds, on the back of the basically the increased deficit that's going to come from the US government. Similarly, with the Kamala Harris, if she were to win, you'd see a rally within clean energies, etc. So there's different areas of the market where we can play depending on the outcomes. What's happening at the moment, though, is that it's a really tightly run event. It's hard to tell. We're seeing, though Harris obviously had that big lead when she got announced, as you would expect when any kind of new announcement happens, that's tailed off through time. And also we've seen Trump's been a little bit more cautious with how he's been phrasing certain things, and that as a result has meant that he's recovered a bit. It's still quite close. Certain swing states are looking red and certain swing states are looking blue, so it's quite tricky at the moment to tell. But that'll become more clear probably, well, certainly over the next fortnight, but over the next week, I would imagine. Inflation, as Mark mentioned, we had a 1.7% reading on inflation this week. That may very well be the bottoming out at the moment, foregoing any unforeseen events, due to the fact that we'll have some base effects from last year starting to come back out. Not just that, we'll have the energy price first rise we've had in a little while, in what, 2 years, I think is the first rise we've had, kick in. So that will affect CPI. So expect a creeping up of that, but we're not heading back towards the 4, 5, 6%, etc. That probably go up to at most expecting the high twos at very most. Government bonds. Some of this actually is copy and pasted from the last quarter because of the fact that it turned out to be, we've gone full circle. So government bonds look like they had found their ceiling again on yields. As I said, they sold up and we've had an increase in yields of about 0.5%, so it was a good opportunity to buy back in. So foregoing any unforeseen events, that should possibly be yields come down, which increases capital value within the portfolios over the next quarter. China valuations, how effective is this stimulus going to be? Whilst, increasing liquidity in the market is undoubtedly going to occur, the thing is, though, is how much is the appetite of the consumer to spend money and also to take on further borrowing? The Chinese consumer is actually sat on a lot of money as it is already. If they, is the appetite there to actually go spending it is the next factor. PMI data, as I mentioned, in the US is a mixed bag. That's going to continue being important, I think, for the next few months. We're seeing that the Fed is communicating very much more that they're more bothered about jobs than they are about inflation. So that there is going to be one of the key factors for certain, I think, for the next couple of months. So far, earnings that have come in have been a bit of a mixed bag. Those financial firms have reported, as they tend to at the beginning of the quarter, so those are the ones that we've got best eye of at the moment, reported very, very good quarter indeed. But that isn't surprising when we had those few volatile events in last quarter, creates periods when they can do a lot of trading, and therefore, as a result, they increase their revenues, their commissions, etc. off the back of that. So that isn't surprising. The couple of so luxury goods, LVMH, they missed and said an uncertain outlook. So we've got a bit of a mixed bag going on here, and it's really important that we go through and look through the details of these earnings calls so that we can help isolate which areas of the market have got the best potential over the next, say, 6 months. And then the big one, UK budget, which obviously is it's been a difficult one because there's been a lot of what ifs, but no one quite knows exactly what's going on. We are seeing at the moment an increased risk premium on UK government debt at the moment. Rather unusually, it's currently yielding more than treasuries, which isn't particularly common. So that's certainly a risk premium being added in there because people aren't quite sure what is going on with the budget. It creates an opportunity, though. We don't see that this is going to be long lasting, the extra yield over and above treasuries. So we've taken the opportunity to buy extra gilts literally beginning of this week and look forward to seeing what occurs on the 30th or the 31st of October. I think it's the 30th. It's going to be a very busy day, that is for certain. And then lastly, just looking at the portfolio positioning, this has actually moved quite a lot over the last month. So a couple of areas of interest. As I mentioned, sorry, it's a little bit difficult because there's so many different rows on one table to present. But you see here, as I mentioned, UK gilts, very much overweight in the lower down portfolios, 4% overweight. Similarly, North American treasuries is 2% overweight in the lowest down portfolio. But what I would say is that as a geography, fixed income is being kept neutral. It's more favouring of treasuries over corporate bonds. We were, until 2 days ago, holding an awful lot of cash in money markets, etc. In fact, on lower down portfolios, we had around about 7% of cash, which is, I think, the highest we possibly have ever held. But we have deployed, as I said, we saw the opportunity with treasuries and gilts. So that's reversed over the last few days. And on the North American equities, which is here, just underneath, we are a bit underweight that at the moment for two reasons. One is, as I said, we're seeing valuation factors, some of which are starting to look a little bit stretched at the moment. And not just that as well, on portfolio fiber, we had a pretty large increase from a couple of our benchmark constituents, but there was such a large amount. Portfolio 5 already holds around about 40-ish% US equity as it is. Not wanting to increase that too much more, just from a risk perspective, not putting all your eggs in one basket, etc. Finding it really important at the moment to keep a diversified portfolio there. So that brings us to an end for this structured part of the presentation. Over to Q&A, etc. We certainly welcome questions, by the way.
Looks like one's, yeah, just pending there. Oh no, it's Judah.
Looks like I've got one coming in. Got a feeling this is going to be a budget question. So, yes, Graham. So, sorry, the question is, the government has been warning for some time about a tough budget. What are your view of risks and opportunities? So, what I've been concentrating on is on the gilts, just because of what we've been talking about in other areas, can be a bit woolly, and if we look at it in terms of in general, they're trying to raise revenues. That typically tends to be a good thing from a gilt standpoint. So that's why, as I said, this increased risk premium compared to treasuries, I don't think it's going to be terribly long lasting. So that's the area that I've been concentrating on. The things that I've been reading this morning on CGT, for example, is that the CGT on property isn't likely to increase because it's already at its optimum level for bringing in revenues. What's likely to be increasing is the CGT on shares, etc. But what I will point out is that obviously all of this is hearsay and not to be treated as gospel whatsoever. But Keir Starmer has said that the touted level of going up into the high 30s is very much wide of the mark. What has been spoken about is maybe bringing it in line with property, so that would bring it up to around about 25%, which would be more beneficial for the Treasury, and again would probably be a good thing for gilts. Other areas of the budget, unfortunately, are going to have to wait and see and be very much ready trading on the day whilst watching. They attended an investment conference, as I'm sure you saw at the beginning of the week, global investment conference, where they're saying about wanting to slash red tape and regulation. This being 2 working days after they introduced the workers' rights bill, so that was an interesting combination of events. I think the problem is at the moment is that there's no uniform messaging, and that's the thing that we're looking forward to seeing is a bit more certainty of what's going on. And no doubt that advisors are going to be very busy, I would imagine, off the back of it. Just see one more coming in.
Yeah, I think the budget, as Sam said, will be harder hitting from a sort of personal financial planning, which was just out the scope of this webinar. So yeah, it's definitely going to be one of the more important budgets of recent times.
I think that's it. I think we'll call it a day. Thank you very much, everyone, for joining. Really appreciate it as ever. Should you have any thoughts or questions, I know full well I'm not the world's best person for throwing questions out on a public space. Feel free to send to myself or Mark, or I think it's invteam@kateberkshire.co.uk. Any questions you might have, or to your advisor. And yeah, we look forward. We like answering questions, so feel free to send them across, and we'll catch you next time.
That's been today's webinar. I'll stick around for a minute or two before I end it off. Yeah, I'll leave the survey open for another minute or two, and then we'll end off at about 11:47.